in a world where everything is kind of like a leveraged casino. So finding things that have slower replacement increases is just the name of the game. Adding leverage in a portfolio and finding an ability to rebalance between assets and use some of that leverage is the best way to use leverage.
Welcome to The Derivative by RCM Alternatives.
Hi, I'm David Dziekanski, founder of Quantify Funds, and we're here to talk about gold and Bitcoin on the Derivative Podcast.
Where are we talking to you from again? Jersey?
Brooklyn, New York.
Brooklyn. All right. I was actually in New York yesterday. Quick dinner, breakfast meeting, and back out to catch my son's baseball game. It was like the nicest day of the year. It must have been so far.
It's finally beautiful in New York after one of the longest winters we've had in quite some time. I imagine there's just going to be a complete exodus out of New York for next winter. That's the yin to the yang of the punishment New York received this winter.
Really? Of like everyone will be, hey, plan something now. We're not staying.
Anyone who can work remote will work remote from New York City next winter after what they just endured this winter for sure. It was some of the coldest days we've had in 10 years, and also just the duration of the winter in general was punishing. So,
ouch. And then you've always been New Yorker?
I have. I am one of the few born and raised New Yorkers. I actually grew up in Manhattan, in Chelsea. I went to college in the middle of the country at Washington University in St. Louis. But came back and, New York's in my blood. I tried to spend 1 to 2 months a year outside of New York, particularly in the winter, because who can withstand that seasonal depression every single year?
Right.
But outside of that, New York is in my blood.
I met with my college buddy in the city there. He's been there, 3 kids, private schools in the city. I'm like, man, I don't even want to know what that costs.
God bless.
God bless.
The pre-tax income for those private schools, including the donations they anticipate you contributing beyond tuition, is just astronomical.
Plus, he's like, then we need a driver to take. There are 3 different schools, of course. So this kid has to go to that school. This kid takes the train. Then I ride the bus with the other kid to the youngest kid. Like, God bless you. Seems like a lot.
Yeah.
So. And Wash U, that used to be the most, speaking of costs, education costs, I think that was the most expensive school in the country for quite a while, right?
I think it had that title for quite some time. It certainly wasn't a cheap college. I did my undergraduate and master's program there as well. I was a triple major in math, finance, and economics, and a master's in quantitative finance. I graduated my MSF in 2007. So
that's a lot of math.
That's a lot of math. Yeah.
Are people still doing those majors? Do you think it's getting AI replaced, or no? We need them more than ever to feed the AI and do the.
I think they are. I think the good programs are incorporating as much programming as possible, because any math skills you have, if you can't be a pseudo data scientist and quant at the same time, I think you will be replaced, right? But if you can, AI is really good for things that can be right like 85% of the time. And AI services and agents will be sold in industries that need better accuracy than that. But I just feel like in the quant space, with so much data out there and ability to capture this data and repurpose this data, that, if you have that programming background alongside that quantitative financial brain as well, I think then there is a place for you in this market. But without the ability to be a pseudo data scientist at the same time, I think it's going to be hard to crack.
Love it. And then how you knew, coming from New York, I always want to get back there, work in finance. That was the goal.
The goal was to do that in a very independent way. So if you want me, I can kind of talk about my journey a little bit. But I worked at a lot of the big banks as an intern and on the Amex stock exchange floor way back, even in my high school days. And I saw a lot of the fallacy of the ivory towers of these big banks. Actually, between my undergraduate and my master's program, I interned at Bear Stearns Sales and Trading in the summer of 2007.
Mm.
And there were like two things that happened that summer that were forged into my brain and I'll never forget it. And they kind of shaped some of my choices that I made in life after that.
All
First one was a lunch meeting with some speakers of people who are, very impressive in their space within Bear Stearns. This is one of the offerings they gave the interns. Um, and they were talking about like mortgage bonds. Again, granted, this was summer of 2007. And I actually had the guts as an intern to stand up and say, why does pooling mortgages together make them less volatile? And I got laughed at. Like literally the entire room laughed at me. And I'm like, I'm not, there's no proclamations of like foresight of what's to come, this or that. I was just asking a question. But like, that question took down that entire bank within 12
Yeah, right.
months. And so that was just eye-opening for me. And they're like, oh, they don't know more than
Y-
anyone else. They might
Right.
actually know less as a
Less.
whole
Or
because
they've
there's
been
this.
like they have the rose-colored glasses on that they're even if their back of their brain knows better, the
Well,
front of their brain is just no. What could go wrong? Nothing could go wrong.
each each firm, each employee in those firms has to drink the juice so much for those firms that it's just like a herd mentality. So where the herd leads, and there's you know a number of these big herds out there, and they're all like considering what the other people are doing. And I think that's how we got into 2008. And the other thing that occurred was there was a new HR manager there. And basically every intern that got brought in from the new HR manager got an offer, and everyone who got brought in from the old HR manager didn't get an offer. It was a coup within like the
Mm.
HR group in Bear Stearns summer 2007. And that showed me very much that like you're just a number if you're working at one of these huge firms. And so I've always had an eye more on the entrepreneurial side. I had more I was more in traditional asset management straight out of my master's program. I actually worked for a company at the time that was called Ladenburg Thalmann, that has been rolled up and acquired a couple times by a firm that now goes by the name Osaic. But we grew at the
Not
time one of the
Ozempic.
not Ozempic, Osaic.
They need a
Um,
rebrand.
they just had a rebrand.
Uh-oh.
But um, at the time, we managed about 1.8 billion dollars of model portfolios for about a couple thousand advisors, independent advisors in that network. So we had one of the larger ETF model portfolios at the time.
Nice.
And I left to join Title, what is now Title Financial Group, in the fall of 2013. At the time, we were called Toroso Investments, and what is now Title
Yeah.
Financial Group. Title is one of the largest white labeler ETF platforms in the country, in the world. Something like 1 out of 9 ETFs in the US launched in the last 2 years has been on a Title Trust. They have over 200 ETFs, 70 ETF brands using the platform for a whole sort of services. And at my time there as a portfolio manager on a number of ETFs. I worked on the new product development team for some time as well, and I was a partner at the firm. It was definitely a whole lot of fun, but it felt like it was time to take the ideas we had and partner with my partners here at Quantify Funds and launch our own ETFs under our own brand. Being able to create and control that brand coming to market was something that I always wanted to do. So there was
Love
a very, very long build up to where we got to today for Quantify Funds. But we founded
I
Quantify.
thought you were going to mention the '07 early '07 bear hedge fund that blew up, right? That was like the first canary in the coal mine
Yeah,
for
yeah,
the whole thing.
yeah.
And
No,
then I have another bear anecdote of my friend in New York, which I never knew at the time. It's like the real problem there, they weren't only using leverage at the bank. All the execs were using leverage in their lives. So they were taking their bear stock and owning their house in the Hamptons and buying boats and all that. So it was like 10x leverage here, 3x leverage personal life. So when that blew, that really blew.
yeah.
I have a
No,
hat. I have a Bear Stearns hat here somewhere, just for posterity's sake.
it's
Um,
it's funny how much of this world is new ways to create leverage.
right? Yeah. But I think leverage in and of itself isn't dangerous, right? It's like if you
Yeah,
have those rose-colored glasses on, you don't see the pitfalls and see the downside. is
Yep.
where you can get in real
There,
trouble.
there's good leverage, there's bad leverage, and then like everything else, it's not necessarily good or bad. It's not black and white. It's like how much are you using, and how are you using it, right? I think that's the important part. When you're leveraging a leverage asset to buy your Hamptons house, I don't know if that
Yeah.
is such a sound way to generate additional leverage. But that's one of the things we're focused here on Quantify Funds is creating an institutional process to create leverage and wrap it into an ETF and offer it to retail so they can have a leveraged offering in their portfolio that does some of the work that they previously had to do themselves on traditional leverage ETFs. And that process of what we're doing here, stacking two assets, it's called portable alpha. It's not new. It's been around for decades. A lot of people might be familiar with the PIMCO Stock Plus funds that have been around for decades. That was, we believe, the actual original first stacked 40 Act product. And the concept is really, really simple. Take two assets that may have correlation benefits between them, leverage a basket that offers exposure to both. And that gives you something to rebalance within your leverage basket to create some diversification and less path dependency compared to leverage ETFs.
Talk real quick. You're on the we've had the return stack guys on here. We did a stacked pod. That was fun. And you're on that website, but you're separate. You're quantified funds. You're not return stack funds. So
Yep.
what's that relationship real quick?
Yep. I've known Corey for about 15 years now. And obviously this is a very similar concept of stacking assets as he has at the return stacked ETFs in partnership with the Resolve guys. And so last summer I approached him about potentially partnering with him. So legally we have a licensing agreement and we're available for sale also, or available to find more information on their website as well. But we have a licensing agreement with them as well on the stacked concept and brand. And very happy to partner with all of them. We think what they're building is phenomenal, and we think that also extends to both the alternative space, which this Bitcoin and gold ETF that we'll discuss later on fits within, and also more high frequency trading vehicles as some of our newer products.
Love it. So you mentioned it there. Bitcoin and gold. What's the symbol? BTGD.
Yep. BTGD, BT for Bitcoin, GD for gold. It's the STKD 100% Bitcoin and 100% gold ETF. We try to be as literal as possible in our name there.
Yeah.
Some people like to think of it as a 2x basket of 50% Bitcoin and 50% gold. I think a lot of people are realizing in today's world that Bitcoin is very much becoming the risk on asset of choice with less downside versus the Qs than we've seen in the past. And gold is the ultimate risk off asset. The stability when there's volatility, geopolitical uncertainty and risks and trade wars, etc. And how we try to phrase it is, look, you understood the value of stocks plus bonds equals one thing, stocks plus bonds plus rebalance equals another. It's the same concept there that we're taking to Bitcoin and gold. Like stocks and bonds lost their correlation benefits. Gold and Bitcoin still have their correlation benefits. So if this is something you want to allocate between the two of them in your portfolio, this is a very good way to add a little bit of overall portfolio level margin through this institutional process called portable alpha.
And I want to go deep on gold and Bitcoin and your kind of thesis on each and questions on that, but just let's stick on this for a second of this, which I call rebalancing premium, right? So you have these two assets, if you just put them together and don't do any rebalancing over time, versus if you rebalance monthly, or Corey's done a lot of work on the timing luck of rebalancing. So ignoring that for a second, if you just have a standard monthly rebalance, or you use bands, I believe, like what does the math show, or what have you seen in your experience and in your thing of like what that premium actually looks like? It's real. Like a lot of times when I read stuff like that, I'm like, oh, this is a mathematical concept, but it's not real alpha for investors.
Yeah, what I would say, I would like to focus on, real actual live data since we've been live, not the back tests, but we launched on October 16th. We actually have a paper that we just launched on our website that you can find at
Yeah.
quantifyfunds.com.
We'll
It's
put it in
called
the show notes here as well.
Yep, it's called the case for Bitcoin and gold. And what we show is a risk reward chart of a Bitcoin ETF, a gold ETF, a 2 times Bitcoin ETF, a 2 times gold ETF, and BTGD, which is the stacked Bitcoin and gold ETF. And you can see it has the highest return of all, including the leveraged Bitcoin, leveraged gold ETFs, and just a hair more risk than just Bitcoin alone. So you're really getting that gold allocation on top of Bitcoin without a significant increase in risk from just owning Bitcoin alone, which that shows the rebalancing efforts and benefits of this product. For the first couple months of the life of this fund, Bitcoin was roaring from 70,000 to about 108,000. Bitcoin gold at that time was trending sideways, even downwards during that period. We actually underperformed Bitcoin a little bit in that leg up, and then everything switched. Gold started roaring. Everyone was looking for a true defensive asset, worried about the solvency of the US debt markets and the viability of the US dollar as a reserve currency over the next couple of years with everything going on in the tariffs world. And Bitcoin started to falter and fell below 80,000 at one point. And so again, this regular rebalancing mechanism between the two allowed us to systematically trim Bitcoin on the way up, add to gold, trim gold on the way up this year, add to Bitcoin. And in the last couple of weeks, we've actually seen both assets do well. So you can almost think about it in these portable alpha products that any day that the assets go in opposite directions with each other, and enough so that you have reason to rebalance, is a win for the portfolio. And oftentimes these are rebalances that we see that people are not doing on their own. Ask people, were you trimming your gold for Bitcoin during the crypto winter? Maybe some were, but on a whole, there's a lot of people we found that believe in both those assets, but weren't really doing that hard trade. And so, for a portion of your Bitcoin and gold allocation, this is a really good way to find more risk reward than just owning them individually outright.
But have you done work on like Shannon's Demon and those kind of educational, right? Like you could put two losing assets together and the rebalancing premium alone will overcome the
Yeah.
negative expectancy and give you a positive return.
Yeah.
I've challenged some people I know to be like, find me two actual losing assets and do the math and show me a return. I'm like,
Yeah.
I think it mainly works just because of the model they used. But outside of that, like if so with that math and outside of your actual returns, like what do you think that rebalancing premium is?
We
5% a year, 10, 20%?
we don't have numbers we can quote on that, but I can get back to you on that.
All right. But it's something, right? It's
Yeah,
something you can eat it.
absolutely.
It's
Yeah.
not just and then you said if they're moving opposite direction, that's when you're winning.
Yeah.
By contrast, if they're moving in the same direction, you're losing, or not necessarily if they're
No, it's just you don't get any real benefit. You don't get as much of a benefit from a rebalance, or you're less likely to rebalance on those days. Obviously, if they're both going up, that's a win. But it's really the days when one goes up and one goes down versus the down days that you win because you have the potential to rebalance between the two. And especially like if you looked at the period we've had in April, BTGD was up 19 and change in April. And both assets did well in an uncorrelated fashion, and both trended upwards. So like when you get periods like that, like this can really, really benefit
yeah.
because Bitcoin and gold have been teeter-tottering back and forth, trending upwards for the last couple of weeks. And so it's not a rebalance every single day, but when it does rebalance, it's just capturing these small little potentials for alpha or outperformance.
And would fair to say, last bit on rebalance, like the more volatile the asset, the more beneficial that can be, right? Like Bitcoin almost seems like the perfect asset for doing rebalancing because you'll get these
Bitcoin,
sharp drawdowns and sharp rebounds.
yeah, the also like stability of correlation over time is definitely helpful, right? No correlation is one for one, but you need volatility and you need correlation benefits. So the more volatility, the more correlation benefits you get. It's a trade-off between volatility and correlation, really.
Bitcoin and gold, I'll let you choose your own adventure here. I want to dig into each asset class and what you see as the benefits of each. Where do you want to go? Which one first, Bitcoin or gold?
Yeah, I would like to start with the commonalities between the two, actually.
Oh, all right.
So these are two
Cheating.
assets.
Yeah, but I'll allow it. Yeah.
Well, then we'll talk. We can dive into the differences after, but these are two assets that, for whatever reason, the world has deemed uh, a potential store of value. One has been around for a lot longer than the other. I think when Bitcoin was mining at 15% a year way back when, it was a totally different vehicle. But post halving last year, Bitcoin mines at 0.86% a year, and gold mines at approximately 1.75% a year. Um, these assets are assets that are
And
just not
for
going. Sorry.
sorry, for my friend George, I like to say, which is a riff off the Smart List podcast for his sister Tracy. But for my friend George, what do you mean by that? That's if you're mining it, that's your expected return. That's like your IRR of buying a condo building or whatever.
No, no, no.
Or
That's
that's
how
the
much new
cost.
supply. That's how much new
Got it.
supply is. There's 1.75% new supply of gold each year through gold
Okay.
mining, and there's 86 basis points of new supply of Bitcoin each year
Got it.
through
Versus
Bitcoin mining.
15
Yeah.
5 years ago or 10 years
Versus
ago.
like 15% when the supply was increasing at a drastic pace. You just at some point you have to look at obviously the pace at which developed currencies are going to be printed, but also the pace at which institutions are going to slowly adopt an asset like Bitcoin, especially in the presidential picture we have this year.
Hmm.
Um, the SEC seems to be, a lot kinder to crypto related products now than they had in the past. Um, and so that drip of adoption from the institutional world and the lack of new supply, if you wanted to relate it to another asset class, I would relate it to residential real estate. Like we're seeing commercial real estate decimated. Obviously, certain
Yep.
parts are doing well. Why is residential real estate doing so well? Well, it's
No supply.
supply, right? We never really rebounded from the housing crisis in terms of new starts, new creation, new builds. And so we've just continuously had this supply constraint. And actually, ironically, the parts of the residential real estate market today in 2025 that are not doing well are the few pockets in the country that have lax building codes that didn't have a supply issue, right?
Right.
Texas and Florida, obviously, there's also insurance issues to consider there too. But supply is a very powerful thing in some of these alternative asset classes. So the states that have no supply constraints or like difficulty coming to market with new products, they're flooded with assets. New York and places like that, where it's difficult to build, asset prices are as high as they've ever been.
Hmm.
Similar concept with Bitcoin and gold. Like over time, the dollar is intended to lose value, right? So finding assets that do not grow in supply at a greater
Is that a bit
rate.
of a hot take, or you think everyone knows and believes that?
Everyone knows and believes that. Like
Yeah.
you can
I
look
don't
at
think the average Joe on the street knows that.
there was I don't have the source of this chart at hand, but there's a chart that showed how much like a suit cost 100 years ago versus today, and how much a car cost 100 years ago versus today. And obviously the price in dollars has gone up
Yeah, and the price of gold's
astronomically,
the same.
but the price in gold is the exact same, right?
Yeah,
So
I've seen that.
gold is a store of your value for the things in your life, right? Much more than just holding a currency.
So supply, I was
Yeah.
gonna ask this later, but I'll get into it now. So we're talking supply. Like I have a problem with that concept that there's limited supply in Bitcoin
Yeah.
because it's like infinitely divisible, right? Or in theory, it's out to whatever, how many digits.
Yeah. Just because you divide a pie, you don't increase the supply of it, right? You just make it uh more easily purchased in smaller quantities, right? That doesn't actually change the supply by dividing it.
Mm, yeah, we could argue that. I feel like it does because you could just yeah, it's like in the old days with the currency and they'd melt it down and now I have two coins. But you're saying
Is
they still it's gonna have whatever. If Bitcoin's at 100,000 and I have half of a Bitcoin, now each of us have 50,000 and the supply is the same.
Yeah, they're not going to create new Bitcoin in that process, right? It's not like
Right.
MicroStrategy or people holding the BlackRock ETFs, et cetera. Like it's not like they all of a sudden are going to get diluted and there's going to be new shares of Bitcoin. They're just going to own 10 times as much, right? Whatever, however they slice
Right,
it.
but it's like you
So,
won't have the same like real estate constraint supply, right? It's like a different type of supply. Like anyone who wants to get some can get some because they'll just get some right, some piece of it at the current price. So to me, it doesn't necessarily drive up price because there's this quote unquote limited supply. Same with gold. There's actually physical limited supply.
yeah. Um, I mean, I see your perspective there. I still just feel that, you could say the same thing about currencies. And if
Yeah.
currencies like lose a lot of value, that's, it goes the other way, right?
Yeah, yeah, yeah.
Um, but
All right. So you had what were the other common cores?
honestly, that's where the commonality kind of ends, and that's kind of the concept of this product is that, they both can offer a hedge towards inflation, a hedge towards currency debasement and devaluation. We view this as a nice alternative in your portfolio, but outside of that, it's completely different, right? Like gold, as we stated, is the same cost for a car in gold 100 years ago as it is today, and that can't be said for Bitcoin at all. So their future might be a lot more similar, and I think if that is the case, that is because the supply numbers are starting to look a lot more similar.
Mm.
And you can also see the change in correlation of Bitcoin will fluctuate between essentially the Qs and gold based on like geopolitical risks and uncertainty around the US markets. It kind of teeter-totters between which one it's more correlated to. So I think in the past there's nothing but differences, but in the future, the concept of this product really is that they are going to look a lot more alike. And people always ask, so when is Bitcoin going to look like a defensive asset? And my response is when the price is a whole lot higher, right? By the time that adoption comes and we can say, okay, this is now a defensive asset, uh, Bitcoin will probably be a lot higher than it is today. And that doesn't mean that there can't be a significant drawdown in Bitcoin. Actually, a really smart economist uh, wrote something saying, this is an asset that went from 1 cent to $100,000 in the matter of like under 20 years. So the likelihood that it could actually jump back 1 to 1.5 decimal points should be considered, even if it is an asset that's on its way to like 1 or 2 million. I truly believe that. Like that's
Yeah.
fully
One
within
or two
the
decimal points. So where does that put
yeah,
it? What are we talking?
five
Like,
grand.
yeah,
Like
which
that's
it did in COVID, right? That was the low somewhere in there.
somewhere around there.
Yeah.
But that'd be a much bigger fall from where we currently stand today. And as the whole concept of this product is, well, then
Yeah.
you better make sure you're still rebalancing it. And obviously, it'll
Yeah.
have a lot of people who like lose belief at that point. If that ever were to occur, I'm not saying it will occur. People
Yeah.
always
Yeah.
ask me, they're like, what is your price target on Bitcoin? I always like to give them two, and it's one that's like below where Bitcoin is and one that's above. And I just tell them I can't tell you which one it's going to hit first. I think it's an
Right.
upward trending asset. The upside over time will be larger than downside, but it's too hard to predict on a day-to-day basis. And quite frankly, I think anyone who's trying to make market predictions in this world,
Yeah. Good luck.
it's just like you have to hang on every tweet. 10 hours can be 6 months in this world, in this economy.
Have you felt over the year, like how long have you been personally involved in Bitcoin? Like, were you buying it way back when?
Yeah, 2018.
Nice.
December 2018 at 3,500 was my first purchase of Bitcoin and Ethereum. Obviously, at Title, we had launched the block ETF on Amplify's Trust, ticker BLOK at the time. I was not a PM on that, but I assisted Dan and Mike on that, and
Yeah.
our interest in crypto related things peaked at that time. And that's one of the beauties at that point of being a small RA. I have a small book of client assets as well, and you can do interesting things and not be withheld to this crazy like do not trade list from the
Yeah.
ivory
From
towers,
exactly.
which goes
But
all the way
what
back. Yeah.
at that time when you were buying, what was your thesis? Did you have a thesis? Or you're just like this, people are moving into here. My whole question is kind of around like the thesis back then is way different than it is now.
My
Seems to
my
me.
my whole thesis for the last 15 years has been like think like a 1%er and what assets they will want. And we bought some land in upstate real estate in 2018, 2019.
Mm,
I was running a gig economy ETF for SoFi at the time through Title. And so just the idea of finding unique scarcity assets has been a search that I've personally been on for 15 years, whether it's Bitcoin, gold, land, the debt situation we were in, and really the QE that we saw over the last 15 years was an equation that at some point had to break. And I think many people lost a lot of money betting early that it was going to break. But we're technically potentially seeing some of that break right now, right? I think the world would respond to QE from the US much differently today than it would in 2020. It's not viewed as a savior for all, it's viewed as a savior for those with assets.
Yeah.
And that's a very, very big distinction. And that doesn't mean there won't be quantitative easing in the future. There absolutely will. And that will be a very big bull case and bull moment for BTGD in both Bitcoin and gold. But it's just that the market and Main Street will take it in a very, very different fashion. So I almost think you're going to need to see more pain before that next bullet of QE can actually be fired. And I'm a big fan of Lynn Alden's work, and she has a fantastic quote of "Nothing stops this train," talking about the fiscal situation we find ourselves in the U.S. with our deficits and debts, and
Jason Buck of Mutiny Funds, he talks about like all that easing, all that deficit is just the other side of the balance sheet from the boomers' savings.
Yep.
Right.
Yep.
And that's like, instead of them taking a 50% hit in the stock market, we just basically gave them that money to prop it up and took it on the government side. So eventually that's going to have to be paid down.
We lowered tax rates on those with assets and increased tax rates on actual earned income, right? So it just made it a lot easier to compound assets and more difficult to compound future assets based on earned income.
We were having a bit of a US crisis here in early April, and Bitcoin was selling off. So, right, it doesn't in the old days, like, yeah, there's going to be the central bank's not going to have enough bullets and the dollar's going to fail, blah, blah, blah. You're going to need to own crypto. But that, right, to me, that's gone away. Now it's more of like what you were kind of saying before. It's like 2x NASDAQ, right? It's like a levered.
Not even. It used to be like 3x NASDAQ. And in April on the downside, it looked more like 1 to 1.25x NASDAQ, right? And that's where we're saying the correlation seemed to come from both the Qs, obviously, but also gold, right? When you saw Silicon Valley Bank fall, you really saw Bitcoin for the first time have like a little light of movement as a store of value, right? And then the Qs run, it starts moving with the Qs, and people and the correlation benefits trend closer to the Qs. But the beta to the Qs has also been dropping at the same time.
But so that's kind of, I guess you're saying it's got all these properties, right? Like people wanted to say back in the day, this is just a central bank hedge, basically.
Yeah.
And for the end of the world, blah, blah, blah. But now it's like, well, it's also can be your penny stock, levered NASDAQ, whatever you want to call it, for upside.
Imagine the process gold took to initially be considered a store of value and what that looked like in the world, right?
Right. We need a time machine.
We need a time machine, obviously. There's no way to know, but it's not like one day everyone was like agreed that this was a store of value, right? That there was a process where gold became more valuable across the world, et cetera. And obviously there were other coins that are considered as well, especially back then.
They were using shells and different things, and gold just became the thing.
Yeah.
But, and could you agree that the whole premise of like, right, it seems like no one's talking about the blockchain is going to change the world anymore for the purpose for Bitcoin and the value of Bitcoin. Like that was for 5 years of like, you have to get into blockchain and buy Bitcoin when blockchain takes over.
I think blockchain will change the world and is beginning to change the world. I just don't know if it necessarily has to be fully associated with actual crypto coins, right? You can see stock exchange adopting a blockchain for trading, right? Really, all it is triple ledger accounting. We went from single ledger accounting, where there's a king who said, "This is how much money you have in my bank," and he can just cross it out and say, "Actually, you have half of that because I don't like what you just did, and you can't do anything about it." To dual ledger accounting, where both sides keep their own records and it's then confirmed on transaction, to triple ledger accounting, where everyone has a ledger of all the transactions, and things can move much quicker because of that. And While we've been in Bitcoin for quite some time, I haven't really pushed too far beyond Bitcoin. My personal crypto exposure probably has about 10% outside of Bitcoin. More is just a hedge, but we thankfully successfully avoided a lot of the alt season and NFT hype cycles that we saw in the past couple of years.
Yeah.
And really for me, Bitcoin has always been scarcity asset. And again, at that point, its mining rate was much higher, so it was much less scarce, but it was still the promise of future scarcity with the future new supply diminishing over time with the halving.
Yeah. But I want you to admit, but you don't have to. But I'm like, come on, a lot of the hype was just hype, right? And you weren't doing it. Like everyone was doing it and they were talking their own books and you need
Yeah.
this because of XYZ.
But
And like,
every innovation cycle comes with a hype cycle. There's a
yeah,
lot of
yeah.
charts on this. Like if it's happening, you could argue it just happened in artificial
AI,
intelligence.
yeah.
There's a hype and an adoption cycle, right? And I think some people assume that you need the crypto blockchain adoption to make Bitcoin a viable product, but it's almost like
Not anymore. That's
almost
yeah.
two different things, right?
Yeah.
Things evolve, and this
Because
became
it's not a good, if it's just about blockchain, Bitcoin's probably not the answer, right?
no, no,
Yeah. It's
yeah.
too slow. It's too everything.
Probably Ethereum's probably the answer. And one of the most interesting data points you can look at, or Ethereum or a competitor, is if you look at the price of Ethereum every time that Bitcoin retouched 100,000 over the last 4 months,
It was lower
it was
lower
lower,
highs.
lower
Yeah.
highs, lower highs, lower highs every time Bitcoin crossed 100. So
Mm.
whether it's another platform that does it or it's just an adoption by firms such as NASDAQ, right, that do it as an exchange, it will make the world more efficient. And Bitcoin still has value, but the two
Yeah.
aren't necessarily the same.
And my last Bitcoin slam, these aren't really slams, but point would be the like to me it was always annoying. Hey, once we get institutional adoption, then this is really going to take off. But it's really like you're basically saying once this decentralized thing becomes centralized, then we'll really have something. So that would always sat with me a little bit weird of like, wait, you want it on an exchange and have all these normal pieces to it, that the whole point of it was to be outside of all that. But now, and it seems like that was right. Like once it got into some ETF forums and groups could buy it and a more easily purchase it more easily, it started to take off again.
I'll put it this way: if you remember in the 2010s,
Barely.
the old Wall Street saying for why the U.S. Kept outperforming, right, was best house in a bad neighborhood, right? Everyone's debt
Cleanest
situation is
dirty
pretty
shirt.
bad. Exactly, cleanest
Yeah.
dirty shirt. Our debt situation isn't great, but look how bad their
Yeah.
demographics and
Spain
debt
and
situation
Greece
is,
yeah.
right? Um, if you are a 1% investor and you have billions of dollars, your biggest risk to your capital pool is the devaluation of your own currency, right?
Mm.
So what else is out there? There's land, there's gold, there's
Yeah.
Bitcoin, right? If we could
Mm.
figure out a way how to leverage all three into an ETF, we probably would.
Hey,
But
next.
yeah. So,
Yeah.
so there's just not that many options for scarcity assets in this world.
I love that way you think about it of right, not just scarcity, but what is that 1% thinking about? What are
Yeah.
they going to buy because your thesis is they're on the front lines of thinking about that scarcity. Just
Of like
because they're
the devaluation of currencies being the biggest risk to their pool of
yeah.
assets, right? So
Is it that why or because they have that much money, they need to find other places to put it?
they need to find places to put it, but also, they need
Yeah, that's their biggest risk.
they need to protect against, again, the biggest risk is that like the currency that they are most highly weighted in loses its value.
Got it. Uh, I lied when I said last bit. Let's talk real quick, Sailor and MicroStrategy and everything going on there. Do you think that's like, is there a Sailor floor to Bitcoin price? Because he'll just keep borrowing and buying more and more. Or what do you think? Is that good, bad, indifferent for price and
I
for the
think
industry as a whole?
I think he's a brilliant man, and I think what he's done is amazing. I think the stock trading at a multiple is something that's hard to overcome. I think it can be used as a very good short-term trading vehicle. We have an ETF that actually stacks MicroStrategy on top of Coinbase, ticker APED. So you get 100% exposure to both MicroStrategy and Coinbase within the same
Aped.
ETF.
Love
Yep.
it.
But it'll really be a buying engine that's available as long as he's able to continue to get financing. So it's really the pace at which he buys over time. Um, you could argue that at some point a floor could disappear on him if he gets too aggressive in the short run. But as long as he's conservative over time, multiple aside, he should be able to continue to acquire Bitcoin. But I don't think you can necessarily consider him an ultimate floor. That Bitcoin case where we talked about it moving 1.5 decimals back probably would coincide with something going really wrong at MicroStrategy, right?
Yeah.
That's the most likely. I wouldn't say cause. I would never say cause of it, but like a symptom along the way towards that.
And when you're saying them at a premium, they're trading higher at a premium to their actual Bitcoin holdings.
Yeah,
So
yeah.
you're like, at some point, that doesn't make sense, you're saying?
At some point, that doesn't make sense, and doing capital events to raise cash to buy more Bitcoin when he's at a discount becomes a little bit harder.
Yeah.
So,
And
um,
why did they give them these cheap loans? I've seen some YouTube and read about that. I don't quite understand it because they're trading like the options on it or something.
they're essentially creating warrants out of it, and they get some options on it
Mm.
through the process. And we're
So the implied rate, the all-in rate is not what's advertised as the 70 bips or whatever.
yeah, I think that the yin to the yang of quantitative easing is that everyone has to essentially gamble a whole lot more. And the stock market resembles a casino, and economies resemble like a casino a lot more. We laugh, but honestly, it's not funny. We're in a world where it's really hard for the average participant in the economy to have any substantial disposable income at all whatsoever. And so I think the result of that is more and more you're seeing straight, whether it's a replacement of sports betting, you're seeing some gambling from both the institutional and retail space.
Yeah,
Advisors seem to be a little bit more muted in between.
love it. Any more Bitcoin thoughts? Institutional adoption, energy usage, any of that good stuff?
No, it's going to
It's
be
all
really,
out there.
it's
Yeah.
going to be a really repetitive, boring message over the next 10 years because it's going to have lots of volatility and the thesis is not going to change. And
Mm.
if, people always ask me, what's the bull and bear case for Bitcoin? What's the bull and bear case for gold? What's the bull and bear case for BTGD, the stacked Bitcoin and gold ETF? Because, you can make a case in an inflationary environment both Bitcoin and gold to be good. In a deflationary environment, both Bitcoin and gold to be good. In a
Yeah.
stagflationary environment, both Bitcoin and gold can be good. Now, I'll preface that with saying maybe not always the first leg of it, right? And more so the response to whatever that issue is might cause the event that actually causes those assets to come up, whether it be more quantitative easing. The one thing that can stop Bitcoin and gold is us cleaning up our balance sheets and us as a country not being the
Getting off
best,
the sauce,
getting
basically.
off the sauce, not being the best house in a bad neighborhood, actually being a sound balance sheet, right? So I like to say the only thing that can stop this train is Doge. And
Yeah.
their leader just bailed. So,
Yeah.
um,
And I don't even think Doge was really like massive across everything, right? Like not just governmentally, but
yeah,
businesses, everyone who's leveraging up and addicted to cheap capital basically is what we're saying. Like you'd have to have a normalized interest rate and people take normalized risks and
yeah.
um
I don't see how we get from here to there in any easy path at all whatsoever. So
so gold. I love the Warren Buffett quote, right? Of like if aliens looked down on us, saw us digging up this thing out of the ground, cleaning it up, selling it to another person who pays to have it put back in the ground and have guards guard it, they'd think we were insane, right? So I have a complicated relationship with gold. I've never thought it really deserves a spot in a portfolio, although I have some now. I've relented. Um,
are you the counter trend? Should I be selling gold right now? No, I'm joking.
yeah, exactly. I probably am. Yeah. No, I relented like 5 years ago.
Yeah.
I was definitely the counter trend like 15 years ago, like, uh, but it's the same concept, right? Like it's, you said earlier, for whatever reason, people have this as a store of value over thousands of years. So, right, that's always sat with me a little weird, but it is what it is. There was no question in there, but just give me your whole thoughts. Gold, have you always been a believer, or you're like, this is what it is, people value it, and I'm gonna play in that space?
I've always been a believer of seeking scarcity assets, and gold has always been a scarcity asset. So gold is something that I personally had in portfolios for 15 years and always viewed it as a great asset to rebalance. I think right now gold is having a moment where it's almost replacing fixed income in people's portfolios. The US had this really weird thing happen in April where we almost felt the effects of what it was like to be an emerging market economy where a volatile moment wasn't a flight to safety, it was a flight of capital out of the country, right? So when volatility spiked in equity markets, it wasn't a run to treasuries. Equity markets had downside volatility, treasuries had downside volatility, the dollar had downside volatility all in unison, which is typically only really experienced in a capital, a flight away from capital in that country, which we've seen historically in emerging markets. And that's really what turned BTGD, because both Bitcoin and gold were providing stores of value. But, I think, again, we're in a world where uh, everything is kind of like a leveraged casino. So finding things that have slower replacement, slower supply
Mm.
increases is just the name of the game. And then rebalancing that with your risk assets. These aren't the only things you need. You need risk assets, you need equities in your portfolio, but adding leverage in a portfolio and finding an ability to rebalance between assets and use some of that leverage is the best way to use leverage, right? You shouldn't just leverage up and go 200% long equities, but if you're going to end up at a target of 110 to 125% exposure, and you have some alts in there, maybe some index managed futures products, et cetera, and also assets like Bitcoin and gold that can provide some diversification from your equity. I think that's the
Yeah.
future here. So
What did you see those? What was the stat? Like the Fed's GDP number went bonkers because there was so much gold imported in the first week
yeah,
of
yeah.
April. So it wasn't just money fleeing US, it was US saying, I want gold.
US saying they want gold, China saying they want gold, the rest of the world saying they want gold. I think the US T-bill as a risk-free asset is theoretically being put into question.
Yeah.
So
What do you think that was kicked off by Russia, like pre-Ukrainian invasion, right? They loaded up on gold because they knew their assets were going to get frozen. I
I mean,
think slowly, I think all the central banks are like, oh, hey, we don't like why Russia did that, but good point. We should have some diversity there in case we get into a row with US and need money.
yeah.
Um, what else do we have on gold? What percent do you think a normal portfolio has in gold, like across retail, across institutional?
What do I think they have, or is that what you're asking?
Yeah, what they have and what they should have, I guess.
I don't have exact numbers, so my understanding is the range is probably somewhere between like 2 and 10%. I know there's some tactical allocators out there that have wholly replaced their ag allocation with gold. I think doing so with a tactical overlay would potentially make more sense in that case.
Yeah.
But I don't think you need a whole lot of this. You need, 2 to 10% in Bitcoin and gold to really move the needle on your overall portfolio, and then have those assets rebalance and rebalance that with your risk asset as a side of the portfolio as well in equities. And I think that's a very, we have actually in our deck, we have a chart where we show what happens to the S&P if you add a 10% allocation to gold, a 10% allocation to Bitcoin, or a 10% allocation to Bitcoin and gold rebalance. And obviously,
On
um,
top or 90/10?
on top.
No.
Yeah, well, 90, 10, and 10, right?
Got it. Yeah.
And obviously that's the strongest performer of the group. But you don't need a whole lot to move the needle. You just need some, because the likelihood that our deficits get higher is almost a certainty, and the percentage of our budget that just has to go to pay back interest is rising. And we have a lot of debt we're rolling over the next couple of years as a country. And, the whole last couple of years has felt weird, I think, to allocators because the debt bubble is not so much on the corporate balance sheet, it's been on the government balance sheet. And we've been able to get away with this as the best house in a bad neighborhood, or however you want to call it, for a very, very long time. And there's ramifications to that. And that's what we're seeing right now.
Yeah, I feel like there's a lot of room for people to add gold, right? Most portfolios, they might have 5% in commodities, but that's maybe 5% of that 5% is actually holding gold.
Yeah. Yeah, both, right? I think BlackRock just recommended at the beginning of the year model allocation of like a 1 to 2% allocation to gold, right? That was the end of last year coming into this to Bitcoin. That was the end of last year coming into this year.
Yeah.
Like, what are the odds that band of recommendation goes up next December? Like,
1,000%.
1,000%. They're like, you should go to 2 to 3
winners.
or 2 to 4.
So they were saying 1 to 2% in Bitcoin as well?
Yeah.
Which has long been, a lot of the people are like, I don't know what this is. I have a buddy who calls it schmuck insurance. He's like, I don't know what this is, but if it becomes a thing, I don't want to be the idiot, so I'm going to put it's worth 2%. Right?
How many times does it have to cross $100,000 before it puts an advisory practice at risk for not allocating to Bitcoin? Especially an advisory book that has older clients that's trying to figure out how to connect with the next generation within their client book. What are the likelihood that that client, the millennial version of that client and that family, is going to be happy with that advisor? If Bitcoin goes to 150, and the FOMO of missing out, again, same thing as we talked about, is like, if you're a 1%er, that's your biggest risk, is like your wealth being destroyed because your currency gets destroyed, right? So you find tons of ways to try to hedge that. And as you said, it's like, I might as well put 1.5 of my assets in Bitcoin then, just in case that occurs. Right?
Yeah. And then even if it moves 2 decimal points, as you said, whatever, you're down a week's worth of S&P.
Yeah. And
or recently an hour's worth, but yeah.
And half the people will bail and the other half will rebalance. And it's our opinion that obviously Bitcoin will over time trend up. But in that case, that could be a buying opportunity of a lifetime.
Love it. What else we got? Got anything else to share with us?
Yeah, we recently launched 4 new ETFs, stacked single stock ETFs. We have 3 different themes. We have an AI theme where we've stacked MicroStrategy on top of Coinbase, ticker APE. So 100% exposure to strategy and 100% exposure to coin. Similar concept, we get to a balance between the 2 assets. So if you're trying to invest in what we like to call like the mega cap crypto stocks, at least we do the rebalancing for you between the 2. We focused on it a lot this podcast. The rebalancing of almost any 2 assets increases the Sharpe ratio of that asset.
I like that. So you're basically you have the little bit levered version of the asset and MicroStrategy plus the kind of the picks and shovels provider, right? For the
we have 2 in the artificial intelligence space. We have NVIDIA and AMD. That ticker is LAYS, LAYS, and we have NVIDIA and SMCI, ticker SPICY, SPCY. And we also have a driverless car theme, ticker ZIPP, which is Tesla and Uber. So fun ways to...
These are the best symbols ever. Well, who's coming up with these? Do you sit around having a beer and thinking of these, or like you have a marketing firm or what?
There's a lot of effort that goes into it. And, I spent a lot of time at Tidal, and Tidal is really good at what they do. And they also assist in a lot of this. And it's
I don't get Lay's.
Chips. So we have Lay's chips and spicy chips. So for AI chips.
Got it.
Yeah.
Lay's. I should have been quicker on that. Come on, Jeff. Zippy, love it. And so can this become, what's the next 5 years look like? You might have 20 of these.
Time will tell. We have an infinite number of ideas in the hopper. I've been sitting around with the Tidal team for over a decade thinking about like what doesn't exist in the ETF wrapper that could exist in the ETF wrapper. It's funny, if you look at a lot of the firms that are doing well in the leverage space, we all kind of spent some time working together at Global X. While I did so while I was with Taroso at the time. But whether it's Justin Young or Greg King, Mike Venuto and Key. We all at one point were sitting in an office together with Bruno at Global X back in the day. So
Did you know Jim Carroll at Toroso?
of course, yeah,
Yeah, he's been
Yeah.
on the pod talking
Great
VIX
guy.
and volatility. Yeah.
great guy. Yeah. Jim, have me on your podcast. Come on. Sure.
Yeah, come on. We'll end with a little bit of fun. What rabbit hole you've been finding yourself go down recently? Either something fun, something work related.
Oh, okay. So something fun. I mentioned I worked remote for a couple weeks this winter down in Costa Rica, and
Ooh, love
at the ripe age of 40 years old, I decided to try to pick up surfing. So
Yes.
I surfed sunrise in Nosara, Costa Rica, at pretty much every single morning. Anyone who knows Nosara knows it's famous for its baby waves. It has like really consistent, pleasant baby waves. There's no rocks, there's no reefs you're gonna hit. There's no like 20-foot waves that are gonna kill you. It's still terrifying, but it was a whole lot of fun. Big believer that, especially when you're very focused on whatever work efforts you're doing, that you need an avenue that is not work to also geek out on. So it was
Yeah.
really fun to do that, and I expect more of New York to be doing that next year, next winter.
I love it. I grew up in Florida surfing, so I know how to
Amazing.
surf. And then it's
Yeah.
been basically my whole last 20 years, like trying to find one time a year where I can get somewhere and get back in the water.
Where do you surf?
Like nowhere, literally. Like, oh, we're going in Mexico on vacation. Let me try and go for 1 hour.
Yeah.
We've been done in Hawaii, California, but it's
Yeah.
been fun getting the kids on there. Like, there's this great group, Corky Carroll's Surf School in California, where and like guys like literally holding the back of the board so they can get up on it, and then pushing them a little. Like,
Those instructors that like can help you out and like stand you up while on the board.
Yeah.
It's amazing.
Amazing.
Yeah, they're the
But
true
I
superheroes.
won for the listeners. I'm doing air quotes. I won at a school auction or something, a house in Costa Rica for a week. So want to use that and get back in the water.
Let me know when you're there.
Yeah, I'll give you a call. Awesome. Well, Dave, not who's Dan? I looked at my wrong screen.
Dan is our partner, actually. So
Exactly.
shout out to
David?
Dan Lee. Thank you. Yep.
Yeah. Thanks so much for being on. Good luck with everything. Go gold, go Bitcoin. And we'll see you next time.
Thank you for having us.
All right.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.